What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey. This week, we're doing something a little different. Instead of bringing on a guest, we brought in AI. We fed our full 2025 year-end market review into Google's NotebookLM and asked it to do one thing: turn a year into a 5-minute conversation. The result is a surprisingly coherent discussion about growth, inflation, policy, and what actually mattered to markets in 2025, and what may not matter as much as people think going forward. Let's press play and see how the machine tells the story.
Today we're going to unpack the 2025 market recap, and this one feels less like a recap and more like, I don't know, a financial fever dream.
It really was a complete study in paradox.
Exactly. You had this extreme anxiety, markets flirting with bear territory, but then the S&P 500 finishes the year up a solid 16.4%.
Which is the third straight year of double-digit performance.
Right.
It's the essential tension of 2025.
Right.
Our sources kept calling it the highest narrative volatility ever. I mean, investors were questioning everything. Recession, WW3, AI taking every job.
All of it. And yet, beneath that chaos, the market leadership was almost boringly similar to the last 2 years.
Shockingly focused, yeah.
So that anxiety in the first half, it was almost all driven by that policy whiplash we saw in the spring. Let's unpack the tariff V-shape.
Okay, so the S&P 500 peaked in February, right? And then it just trended sharply down, paralyzed by these escalating policy fears.
And it all came to a head on April 2nd.
That's the day. The administration announces these huge new tariffs, the so-called Liberation Day tariffs. We're talking 25% on Mexico and Canada. It was a systemic shock.
A total shock. Investors immediately priced in supply chain chaos, inflation.
And the market plunged 18.9% off that February high. It really felt like we were staring down a bear market cliff.
But then, just a week later, this euphoric reversal. On April 9th, they announced a 90-day reciprocal tariff pause.
But not for China. Their duties actually went up.
Right, and that announcement sent the market into orbit.
It was the biggest collective sigh of relief I can remember. The S&P surged 9.5%. in a single day.
That's a historic move.
Oh, it's a top 10 day since 1929. The largest single-day gain since the depths of the 2008 crisis and the rally that came after. Just one of the sharpest V-shapes ever, up over 37% from those April lows.
And here's the real puzzle piece. Despite all that insane policy drama, the market's internals, they were completely consistent.
Utterly. Large growth stocks. Your biggest companies with the fastest growth were the undisputed champs for the third year in a row.
So stable.
Extremely stable. Communication services was up 32.4%. You had technology as the other top sector. It all points directly to the accelerating AI story.
This wasn't a broad market thing. This was intense concentration.
It was. We saw NVIDIA cross $4 trillion in market cap in July, and then, what was it, just 3 months later?
October. It surged past $5 trillion. That pace is just, it's wild.
It's genuinely unprecedented.
And all that growth did something pretty incredible to the S&P 500 itself, didn't it?
Oh, absolutely. The sheer size of tech and communication services combined is now approaching 50% of the index's total weight.
50%, half the index. And that concentration is the critical takeaway for you.
It is, because when half the index's value is tied to just a handful of giants, passive investing suddenly has a very different risk profile.
Which brings us to the Fed. The policy backstop. They were so reactive this year.
Well, they had to be. They paused rate cuts in the first half because those tariff threats. That's textbook inflation risk. Higher input costs, supply chain problems.
So they couldn't ease into that.
Exactly. But then the narrative completely shifts in the second half. They deliver 3 25 basis point cuts, ending the year at 3.75%.
And what gave them the green light? It all connects back to the labor market.
Yeah, unemployment did tick up from 4.0 to 4.6%, which normally sounds alarm bells.
But it was the speed of the rise that mattered.
That's the key insight. The data shows it was the slowest increase since 1950. It was ideal for markets because it signaled a gentle cooling, not a collapse.
And that allowed the Fed to ease without signaling panic, which is why we saw those green shoots in housing.
Right, as mortgage rates came down.
Okay, before we wrap, we have to touch on the massive divergence in commodities. Oil fell almost 20%.
While precious metals went parabolic, I mean, gold up over 64% is huge, but silver,
148%.
148%. This wasn't just inflation hedging. This was hedging against extreme global policy uncertainty. The tariffs, geopolitical tension. When systemic fear peaks, that's where the capital flows. Strongest year for both in over 30 years.
So we end the year with this clear story. U.S. leadership AI, large growth, stayed firmly in place despite all the trauma and the plunges. Consistency in the face of chaos.
It was. But here's a final provocative thought for you to carry forward. The U.S. market did well, but it actually underperformed a lot of global markets.
Like Korea and Taiwan.
Exactly. Korea up 92%, Taiwan up 30%. And the key difference is that in those markets, traditional value factors were the dominant theme. That's a sharp contrast to the size and growth dominance we saw here.
So the question is,
does that global rotation toward value signal that the amazing consistency we've seen in U.S. market leadership might finally be poised for a shift? Something to mull over?
Well, that's where it ended. It hit 5 minutes exactly. So my thoughts are, it's a little bit cheesy, a little bit forced, but it got some of the nuances across, which I thought was interesting. I didn't want to make it too long. We'll see if it's better next year. So next week, we will be back with what's next for markets to talk about some of the key aspects of our outlook for macro and markets in 2026. Thanks for listening.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.